letting any more go. So the idea that you can have a new gold pool facility whereby central banks get together and they feed gold into the market in order to control the price, no, that's not going to happen. It cannot happen. Importers into India who store their gold, if you like, in customs warehouses until it is actually required. Otherwise, they have to pay tax on it. Apparently, they have been taking advantage of the arbitrage because, when the premium on COMEX is, say, 10 or 12% annualized, then, this is an arbitrage which, is actually quite profitable.
In today's news recap, JP Morgan and other big banks are flying billions of dollars worth of gold on planes. JP Morgan Chase alone plans to deliver $4 billion of gold this month, according to security filings. Trump's tariffs are already having unintended and somewhat strange economic repercussions. For example, they have led to big banks transporting billions of dollars of gold via commercial planes from London to New York City. The price of gold, which investors tend to buy during times of heightened risk, has been on the rise. Gold futures, contracts for the future delivery of gold at a set price that trade in New York's commodity exchange, have risen 11% this year and closed at $2,909 a troy ounce on Wednesday. The Wall Street Journal reports that some analysts project that future contracts could soon reach $3,000 for the first time. However, following Trump's election and his threat to impose tariffs on Europe, the price of physical gold in London has been trading about $20 lower since early December. Normally, prices in these two markets move in sync because traders can ship gold between them whenever there is a price gap. Banks play a big role in these markets by holding gold bars in London, lending them out to earn returns, and protecting themselves from potential price drops by selling futures contracts in New York. However, banks that had sold gold futures are now facing losses as U.S. prices surged above those in London. Rather than buying back futures at a loss, they have a better option: shipping physical gold from their London reserves to New York to fulfill their contracts. This move allows them to avoid losses on their earlier bets and even make a profit by selling additional gold at the higher U.S. price. This gold rush has triggered a logistical nightmare, with some clients waiting up to a week to retrieve their gold from the Bank of England's vaults. Additionally, COMEX contracts require gold bars to be a specific size, forcing traders to send their gold to refineries for recasting before shipping it to the U.S. Finally, the cheapest and safest way to transport such large amounts of gold is via commercial flights. According to the Wall Street Journal, banks are using security firms to move the gold in armored vans to London's airports. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Any individual bullion bank getting into trouble, bear in mind that these bullion banks are usually the subsidiaries of larger banking operations. So that, the first line of defense is that, problems, if you like, in gold and silver paper contracts can be hidden in the wider banking system's numbers. And the second thing is that there will be an absolute determination of the central banks, particularly the Fed and the Bank of England, to ensure that none of this emerges into the public domain. Because apart from anything else, if you think about it, the gold and silver futures contracts and forward contracts are, if you like, the fundamental building block for the whole of the offshore, the over-the-counter and regulated derivatives mountain. We're talking about hundreds of trillions of contracts which would fall apart if there is a serious systemic disruption in the gold and silver derivatives. Having said that, it seems to me it's a very convenient cover for a bigger problem, which nobody has mentioned at all, and that is, okay, this gold is coming out of the Threadneedle Street vault, which is predominantly a storage facility for other central banks. I mean, yes, you find that JP Morgans and all the rest of it do have storage facilities at the bank. But the reality is that they don't actually store all that much gold there. It is, if you like, part of the liquidity, the coming and going. I mean, you may remember that I think it was GLD, the big ETF, suddenly reported in one of its quarterly reports that it had, I don't know, sort of 20 tons or 10 tons or something stored at the Bank of England. And everyone said, what?
Yeah.
So, you do get that sort of thing. But the quantities being taken out, which create this 4 to 8 week queue, according to the Financial Times, not denied by the Bank of England, incidentally, suggests to me that what's happening is that leased gold is being withdrawn. Now, of course, if you lease gold, you're perfectly entitled to take possession of it. Normally, what happens, after previous experience, is that when you lease gold from the bank, lease gold which is from a central bank which is stored in the Bank of England, you will get a cover note certificate, if you like, rather like a certificate for delivery on COMEX from the bank saying, yeah, we're holding this gold for you. Because once it's leased to you, you effectively have possession of it. But you obviously don't take possession and store it in your office. You possess it, as it were, in a vault, so they're withdrawing it. And this I think is fascinating, because will it ever get back? Is everybody going? Are the bullion banks going to turn around to people who've taken delivery, stood for delivery, and say, by the way, we'd quite like to have some of that gold back. Do you mind?
In today's news recap, South Korea's mint halts gold bar sales as supply tightens. South Korea's mint has temporarily suspended sales of gold bars, adding to signs of widespread tightness across markets for physical precious metals. The Korea Minting and Security Printing Corp said it's facing problems with sourcing supply and managing demand, and that it will try and resume sales as soon as possible, according to a notice on its website. The move comes as traders worldwide rush to deliver bullion to the U.S. ahead of potential tariffs on the metal. Prices for gold on New York's COMEX have surged above international benchmarks, resulting in unprecedented tightness and record outflows from London vaults. The precious metal has made fresh highs in 2025 as growing trepidation surrounding U.S. President Donald Trump's disruptive tariff announcements drives demand for haven assets. Investors are trying to get a read on the potential implications for the global economy, reinforcing bullion's role as a store of value in uncertain times. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Out a futures position by selling out a long position or buying out a short position. The owner of a long position decides to take delivery. In other words, what he does, he stands for delivery, but he doesn't actually take delivery. What happens is that it gets reallocated within the bullion bank's vault position. Whether it's Goldman Sachs or JP Morgan or whatever. That there is, however much gold you stood for delivery, you get a certificate from them saying that, we're holding this on your behalf. So it's rather like an unallocated account, if you like. I mean, the problem always with derivatives, and particularly with gold and silver derivatives, is that derivatives are credit markets, whereas the physical metals are not. I mean, they are delivery markets. And the point about a credit market is that you want to deal in credit. You don't want ever to have to deliver anything. So that was the whole point behind the futures market, and the London market, the so-called spot market, gets around it basically by forward settlement. So you can buy something for forward settlement, and it is assumed that you're using this as a temporary position, and when you close it out, you will probably take a profit or take a loss by doing the contrary position rather than taking delivery. But, I mean, going back to the COMEX futures, the problem is that it was a market where deliveries were not meant to happen. And of course, as I said, they've got round this. The bullion banks have got round this by issuing another form of credit, a certificate to you who stood for delivery that, don't worry, we've got your, we are committed to deliver the gold to you, should you require it. But please don't ask for it. That's roughly the position. Now, over the last 4 years, when I started collecting these statistics, the stands for delivery on COMEX have amounted to over 2,100 tons. In fact, including this year, the pace has accelerated since January the 1st. To the point where the stands for delivery this year, if it continues at this pace, will be over 2,000 tons this year alone. So You can see that this is becoming a problem. Now, from the bullion bank's point of view, they have these commitments, and these commitments are probably turning sort of rather real, because it's not just the stand for delivery process, but people are actually beginning to say, hold on, we actually want to submit this certificate in return for our gold. Please, can you deliver it to us? And so this is, this is an increasing problem. And I think the point about the Trump presidency is that nobody outside America basically trusts Trump. They see him as unpredictable. They see the whole thing as, the decline, if you like, the political decline of America. They're uncertain about tariff policies. Basically, they see America screwing up the world. I think that's probably a reasonable description for the average view of the foreigner, you, me, everybody else. So on that basis, if are you still going to be happy? Let's say with a certificate from JP Morgan saying, don't worry, we've got your gold. Don't worry. Here's a piece of paper which says that we have. So you can see that.
So what do you think of today's episode? Do you agree with Peter Schiff's prediction that gold will hit fresh all-time highs next week? Are we on the verge of seeing gold break through its previous records, or do you think it's all bollocks? And what about silver? Where do you see its price heading in the short term? Drop your honest price predictions for both gold and silver in the comments below. I'd love to hear your thoughts. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.